Good afternoon, everybody. Uneducated Economist here. So I want to talk a little bit about R-star. This is something that I have mentioned to a lot of people if they've ever heard of R-star, and nobody knows what I'm talking about when I say R-star. This is a Federal Reserve indicator, metric, tool. I'm not sure how to quite describe it. And I'm not sure if I quite don't even understand how they come up with R-star, but I found this speech called the Future Fortunes of R-star, Are They Really Rising? Given by John C. Williams, given on May 15th, 2018. Now, in this speech, he talks about R-star, and he talks about how R-star is the indicator used to determine interest rates, or actually future interest rates, or where interest rates are going to be. That's probably the way I should say it. And I'll kind of give you some parts out of this speech that'll give you a little bit better idea of what R-star is. It says here, R-star is what economists call the natural rate of interest. It's the real interest rate expected to prevail when the economy is at full strength. Still doesn't make quite a whole lot of sense. He goes on to describe it with an example like this. My own view is that the R-star today is around 0.5%. Assuming inflation is running at our goal of 2%, that means the typical or normal short-term interest rate is 2.5%. When put into historical context, R-star stands at an incredibly low level. In fact, a full 2 percentage points below what a normal interest rate looked like just 20 years ago. So even that still is just like a little confusing on what R-star really is. And he says here, R-star matters a great deal because it anchors where short-term interest rates will tend to be in the future. There we go. That makes a lot of sense, okay? R-star matters a great deal because it anchors where short-term interest rates will tend to be in the future. So it's what everybody kind of expects or is anticipating, and how they come up with this R-star. Again, I kind of looked into it and I was just kind of confused by it, but I found this speech and I thought it was interesting, so I did the video on that. I wanted to do it just straight up on how they come up with R-star, but I found this to be more interesting of a topic. Anyway, R-star matters a great deal because it anchors where short-term interest rates will tend to be in the future. Now, it goes on to say here, recently some economists and central bankers have pointed to signs that the fortunes of R-star are set to rise. I wish I could join the optimism, but I don't yet see convincing evidence of such a shift. The longer run drivers still point to a new normal of low R-star and relatively low interest rates. Now remember, this is given on May of 2018, long before recession and COVID and all that other stuff. What drives the fortunes of R-star? I have already mentioned that R-star is driven by long-run structural factors beyond the influence of central banks. But what are those factors, and how do they influence the fortunes of R-star? And he goes in to talk about three topics of it. The three key global developments have caused R-star to come down in a number of developed economies over the past 2 decades. Number 1, changes in demographics. Number 2, slowdown in productivity growth. Number 3, a heightened demand for safe assets. So those are the 3 key developments that have caused this R-star to come down. Goes in to break each one of them down individually. And this is where I found that the shift has started to take place. Because you think about the very first one. He talks about when people expect to live longer, they tend to save more for retirement. And this increased savings puts downward pressure on interest rates. So you guys get that? I mean, everybody kind of assumes that things will carry on the way they are. Like, I need this much for retirement. Well, you don't know how much things are going to cost into the future, so how could you possibly know how much you're going to need for retirement? So you kind of have to have like this expectation that things are going to continue into the future and get bigger, all right? So when people live longer, they tend to save more. So like as before, we used to have to save this much. Now we have to save in ever-increasing amounts of it. And he's saying that is putting downward pressure on interest rates. And that's happening because if you think about it, like I know right now it's kind of hard to wrap your head around because so many things have changed since this speech was given. But try and set yourself back there a little bit and then, kind of understand what he was saying. And then we'll kind of come here to the future or to the present again. But in the future, considering the speech, and try and see how they relate to. So what he was saying back then is that, people are going to be living longer. They're going to be saving a lot more for the future. And this savings that people are putting into the bank, essentially, even though they weren't getting an interest rate, is putting downward pressure on interest rates. Because if you think about it, if a bank or somebody who is in need of deposits or needing of somebody to commit their savings to them, right? If that is the case, then they're going to be asking for an interest rate. If they cannot find it, they'll give more interest rate until they are able to find that person. And that's just like the simplest way to understand how it is that savings and the glut of savings that has taken place is putting downward pressure on interest rates. And that's what he is saying right there. When people expect to live longer, they tend to save more for retirement, and this increased savings puts downward pressure on interest rates. On the other end of the scale, he's talking about the fertility rate. He says labor forces, because we've had a lower fertility rate since the baby boomers. Labor forces is forecast to grow just 0.5% per year over the next decade. Fewer people joining the labor force means fewer people working, producing, and consuming things, which leads to slower growth and less investments, which in turn drives R star down. So you get that? People living longer, saving more, less people being born, joining the workforce. This is a problem. He goes, and then he goes on to say, the same thing is true for productivity growth, which has slowed compared with the earlier decades. In the 1990s and the early 2000s, the explosion of the internet and computing power led to annual productivity gains averaging 2 to 3%. Productivity gains since the recession have generally hovered around 1%. I have a sneaking suspicion it's because we're using technology to play Candy Crush instead of increasing productivity. While I can only hope we're on the brink of another game-changing innovation like the internet, for the moment, the data indicates productivity growth is still stuck in a low gear. So I think about that for a little bit too. All these three things that are in conjunction with each other that are keeping the R star low. This is the perception of interest rates being low into the foreseeable future. Now, the third and final factor holding down the R star is the high global demand for safe assets. Now, this is something that I've thought about, okay? This is something that, is really kind of coming into gear right now when you think about things, okay? So think about this one again. The third and the final factor holding down R star is the high global demand for safe assets that we've seen developed over the past 2 decades. This has driven down the returns on treasury securities and safe short-term loans relative to those on riskier assets like corporate bonds and equities, and thereby depressed R star. Think about these three things for just a second. Let's go back to the first one, talking about the demographics. When people expect to live longer, they tend to save more for retirement, and this increased savings puts downward pressure on interest rates. Now, I thought about, since this speech has been given, I'm not, kind of get a little sidetracked here, I am not one who follows, like, the news. I don't know what's going on with COVID. I don't know the numbers. I don't know how many people have died. I don't know how many people are sick. I don't know anything about that stuff. I do not pay attention to it. I only follow things that have to do with the Fed and money and stuff like that. I am probably the most clueless person when it comes to COVID and what, any statistics that go with it. What I do know is that a lot of people are telling me that the old people are at risk and they're dying like crazy. Okay? At least that's what I hear. So many deaths. I mean, they spit out some number. I don't know what it is, and I don't know what that means, as far as deaths go, how many. I know one person who's died, of a COVID-related illness, and it was because after they got COVID, they died shortly after that. It went very quickly. I was very surprised. So it's not like it doesn't happen. So it's got to happen out there. And so I think about, like, when people are expected to live longer, well, right now they're not really expected to live longer with this COVID, right? The perception has changed. People are worried about the old folks and that everybody's dying off and everybody's going to get sick and die, right? And as far as the fertility rate, something interesting, when I was talking to my wife about this, she says, yeah, well, what about all the quarantine babies? And I said, the what? She was like, yeah, the quarantine babies. She goes, I know like four of my friends who have gotten pregnant over this quarantine thing. since it all took place. And I'm thinking, oh man, everybody said that's true. A lot of people are talking about there are going to be a baby boom. These are two demographic shifts, right? Now, I mean, I don't know how impactful COVID is going to be as far as the death rate goes on, that on the population. All I'm thinking of is just the perception, right? Because inflation is really more about, anticipation, perception, more of like expectation, not really like a real thing, because like if it was a real thing, then inflation would already be here because they've printed up, trillions of dollars that would cause, prices to be just astronomical. So it's more about inflation expectation that causes inflation than it really is like, the inflation itself, because it should already be here. And when you have this R star, which is kind of like a kind of like an indicator, not like a predictor, but more of like just kind of an indicator of where interest rates are going to be into the future, then you would have to think that with the population being exposed to this COVID thing and having like a population deterioration, then just the level of like change in that indicator should start moving in the direction of higher interest rates. I don't know. I kind of got a little sidetracked there. These guys are over here kind of goofing with me. But anyway, let's continue on. Talking about the baby boomers, though, right? So this is going, or not the baby boomer, but the quarantine babies. If this actually does lead into it, I mean, you think it's going to be like 20 years from now before like any of these kids actually make it to like, a working age. So even though it's like a thing that's taken place, it's really not going to have a real effect on the economy for a ways down the road. But it's an indicator that would lead to believe that the R star is going to start increasing if you take that into account, that this baby boom or the lack of fertility rate has caused it to go down. Then that should be a shift and start changing and go the other direction. Anyway, I hope you guys are still with me. Anyway, here we go. Talking about the productivity growth. Now, one thing that I found interesting in this is because he was saying that, how did he put it? While I can only hope that we're on the brink of another game-changing innovation like the internet, for the moment, the data indicates that productivity growth is still stuck in a low gear. And that's the whole thing about it. It's like, it's not so much like the level that you're starting off from or the level that you're at. It's the productivity growth, that 2 to 3% on a regular basis. That's what they're like looking for. It doesn't matter where you're at in the game, so long as you have that continual growth, and that's what they're looking for. Something that I found interesting in the statement there, that he's saying that he wish he could, or that he was hoped to find that we're on the brink of another game-changing innovation like the internet. Well, we were on the brink of a game-changing innovation. We got blockchain just about ready to bust out all over the place. Bitcoin's up at $40,000, which is just still like astonishing me. I'm just expecting it to be back down at like 25 any minute now, because these things are just incredibly volatile. But it seems like it just keeps going higher and higher every time I refresh my my wallet to see where we're at. So I think that's a change that's taken place now too. And that with the huge drop in production that has taken place and the recession that has, wreaked havoc on the economy, we only have one direction that we can go with production, and that's kind of going upwards. Now, it's not just one direction. I mean, we could go down, but for the most part, if we have hit the bottom and we're on a, growth period from here on, then we should see plenty of growth taking place. And with an innovation like blockchain, we should see a lot like the internet taking place here real soon. Anyway, that's kind of how I see it on that. The third and final factor, this one holding R star down. The high global demand for safe assets we've seen develop over the past 2 decades. This has driven down the returns on Treasury securities and safe short-term loans relative to those on riskier assets like corporate bonds and equities, and thereby depressed R star. That, I think, is going to change real soon. And we're starting to see it happen already with the 10-year Treasury. The 10-year Treasury has ticked up. It's over 1% now. It's like at 1.1. This is interest rates, like everything as far as interest rates will follow the 10-year. Where the 10-year goes, all interest rates go. It's like the number one indicator of where interest rates are headed. And talking about how the demand for safe haven assets has caused, these interest rates to go down and thereby be depressing the R star, I can only assume that if that trend continues, that we're going to start seeing that all three of these elements that are keeping the R star down, keeping the interest rates down, are going to change and reverse and start going up. He goes on to say, and this is funny how he describes it in here, because he calls it all this doom and gloom caused by demographics, productivity growth, and the demand for safe assets may come as a surprise. We're now in the second largest expansion in U.S. history. So to him, the demographics, the productivity growth, and the demand for safe assets is doom and gloom. All this doom and gloom caused by demographics, productivity growth, and demand for safe assets may come as a surprise. We're now in the second largest expansion in U.S. history. So would it mean that it's not doom and gloom if all those things were to change? I don't know. I will leave a link down in the description for the speech. Uneducated Economist. You guys let me know.